Taxes are your largest lifetime expense, larger than your house, larger than your cars, larger than everything else combined. The average person pays over $400,000 in taxes over their working life, maybe more. Yet most people spend zero time trying to reduce it. This is insane. You'll research for hours to save $50 on a TV, but you won't spend 10 minutes learning to save thousands on taxes. Why? Because tax law is boring, complicated, overwhelming. But ignorance costs you more than any other financial mistake. Tax avoidance is legal and smart. Tax evasion is illegal and stupid. Avoidance means using legal strategies to minimize taxes. Evasion means hiding income or lying. Never evade, but absolutely avoid. The government expects you to use every legal deduction and credit available. Tax-deferred accounts are the easiest strategy. Traditional 401k, traditional IRA, HSA. Contributions reduce your taxable income today. If you're in the 22% bracket and contribute $10,000, you save $2,200 in taxes immediately. Plus, it grows tax-deferred, but you pay taxes on withdrawals in retirement, hopefully at a lower rate. This works if you'll be in a lower bracket later. If not, Roth accounts are better. You pay taxes now. Grow tax-free. Withdraw tax-free. All gains are yours. The HSA is the ultimate tax account, health savings account, triple tax advantage. Contributions are deductible. Growth is tax-free. Withdrawals for medical expenses are tax-free. No other account offers this. Max it out every year if you have a high deductible health plan. Capital gains are taxed differently than income. Short-term gains are taxed as ordinary income, up to 37%. Long-term gains are taxed at 0, 15, or 20%. Just by holding investments over 1 year, you cut your tax rate dramatically. Tax loss harvesting reduces taxes on gains. Sell losing investments to offset winning ones. You can deduct $3,000 in net losses annually. Excess losses carry forward. This strategy can save thousands yearly, but requires tracking, planning, intentionality. Real estate offers huge tax benefits. Mortgage interest is deductible. Property taxes are deductible. Depreciation reduces taxable income even while the property appreciates. Rental income can be offset by expenses. Real estate investors pay far less tax than W-2 employees. The 1031 exchange lets you defer capital gains on real estate sales. Sell one property, buy another of equal or greater value. No taxes until you cash out. You can do this indefinitely. Building wealth without tax drag. Business ownership creates tax advantages employees can never access. Business expenses reduce taxable income. Home office deduction, vehicle deduction, travel deduction, phone, internet, equipment, all deductible. A side business can save thousands in taxes. Tax credits are better than deductions. Deductions reduce taxable income. Credits reduce taxes dollar for dollar. A $1,000 credit saves $1,000 in taxes, regardless of your bracket. Child tax credit, earned income credit, education credits, retirement savers credit. Find every credit you qualify for. Charitable donations reduce taxes if you itemize. Donate to qualified charities. Deduct the full amount. If you are in the 24% bracket, a $1,000 donation costs you $760. You gave $1,000, but saved $240 in taxes. Bunching donations into 1 year can help. If you normally donate $5,000 annually, but don't itemize, you get no benefit. But donate $15,000 in 1 year. Nothing the next 2. Now you itemize 1 year. Take the standard deduction others. This can increase your total deductions significantly. Timing income and expenses matters. If you're expecting a raise next year, defer income to this year, or accelerate deductions into this year. Small business owners have more flexibility here, but doubled-out 2 employees can sometimes defer bonuses or time large purchases strategically. Self-employment tax hurts, 15.3% for Social Security and Medicare. Employees split this with employers. Self-employed pay both halves, but you can deduct half on your tax return. And business deductions reduce what's subject to self-employment tax. Retirement contributions reduce self-employment tax. Solo 401k, SEP IRA. These reduce both income tax and self-employment tax. Double benefit if you're self-employed. Max these out. State taxes vary enormously. 7 states have no income tax. Some have no sales tax. Property taxes range from 0.3 to over 2%. Where you live affects how much tax you pay. Retirees especially should consider tax-friendly states. Estate taxes can destroy generational wealth. The federal exemption is high, over $12 million. But some states have lower exemptions. Plus, inherited retirement accounts now must be withdrawn within 10 years, creating huge tax bills for heirs. Estate planning can minimize this. Gifting while alive reduces estate taxes. You can gift up to a certain amount annually per person tax-free. This removes assets from your estate, reduces future estate tax. Plus, you get to see your gifts help people while you're alive. Work with a tax professional, not H&R Block, a real CPA or EA who understands tax strategy. Yes, it costs money, but a good tax professional saves you far more than they cost. They know strategies you don't, credits you'd miss, deductions you didn't know existed. But educate yourself too. Don't blindly trust anyone with your money. Understand the basics. Ask questions. Learn enough to know if your professional is competent. This is your money, your responsibility. Tax law changes constantly. What worked last year might not work this year. Stay informed, read updates, adjust strategies. Tax efficiency is not set it and forget it. It's ongoing optimization. Most people overpay taxes through ignorance, not malice, just lack of knowledge. This is fixable. Learn the rules. Use the strategies. Keep more of what you earn, because every dollar saved in taxes is a dollar that can compound into wealth. Start today. Review last year's return. What did you miss? What could you do better? Plan for this year. Implement strategies now. Your future self will thank you.